All right. Good morning, everybody. So the tariff war continues, escalation between the U.S. and China. From where I sit, every nation in the world right now is being very kind and very generous. They own massive amounts of our debt. And if they really wanted to hit back in a coordinated effort, they could dump our debt. And that would send a very clear message. So far, they haven't done that. We are seeing a sell off in bonds. Can't necessarily attribute that to a coordinated effort, but um, on the left here, where I normally have the 10-year, I've got TLT bonds, two different colors in the box here. It kind of highlights when we were falling through this area, the ES was actually rising at the same time. And then we had a bit of a pause and a consolidation, and then bonds continued to fall, and the ES started to fall with it. It was a regime change. Things were different at that point. It's worth noting that in the second box in that fall, we also had the dollar participating in that fall. And the little bump here was the same bump that we got here and the same bump that we got there. Orale. Hey, good morning, everybody. At some point, this won't all be doom and gloom, right? We'll have something better to talk about. But for now, just what we got. So, read around the world, surprise. We are up off of the lows, and I've seen a lot of talk about how bad this current market is and comparing it to previous events in history. If you're doing that sort of work, just remember there are different types of bear markets, or at least different reasons for bear markets. And so they get put into a different category. If you're going to go back in history and just compare a 20% drop, which is the common measurement of a bear market, and you just go back and say, well, we fell here 20%, that was a bear market. We fell here 20%, that was a bear market. The why matters. The type of bear market matters. And you can hit AI and just ask it to clarify that a little bit. Some may be considered a cyclical bear market. Some would be a policy driven bear market. Others would be an event driven bear market. You get the idea, right? And there's a number of different types of bear markets. So it does help if you're going to compare bear markets to at least compare them in the proper grouping. If you need an analogy to kind of put that into context, you wouldn't look at a Porsche and then look at a go-kart and say, well, they're both vehicles with four tires and an engine. So let's compare these two motor vehicles. It really wouldn't be fair to compare a go-kart to a Porsche. So if you're going to compare bear markets, compare them in the group that they belong to. You'll probably get more accurate data so that you can make a more informed analysis. I thought we were going to get FOMC minutes today. There they are. This is just the minutes. It's not an FOMC meeting. We won't have, Powell coming out and doing his talk. And I'm making the extra effort to point that out because in the past, I've seen people mistake FOMC minutes with an FOMC day. Two completely different events. So today we will get minutes at 2 o'clock. It will have information in it that we did not get from FOMC. So we are collectively looking for the minutes to provide some info, but it's not going to have any info about the crisis of tariffs and retaliation. So it's not going to solve our problem here. It's not going to, bring us out of this dive to the downside or anything like that. Typical Wednesday, we're going to get some crude info. We have an auction today. It's the 10-year. We're not supposed to have favorites, but that's my baby. I like it. I know it's a bit early to express affection for bonds, but I do like this one. Watch the clock with the auction at 1. We want to see where we're lined up in the day, near a high or near a low. And in the afternoon, watching the clock has been providing some opportunity anyways. We've been getting some nice liquidity on the half hour and on the whole hour recently. So, get it while the getting's good. We have a lot of Fed speakers out there chipping teeth. It does not hurt to listen to the song that they're singing, see if they're all starting to synchronize on the same page. Throughout the years, the Fed has been accused of horribly managing their messaging, and they continue to say, we're doing great at messaging and we're getting better every day. And they don't like to shock markets. They don't want to surprise the market. So if they all start to sing out of the same book with the same message, then they're looking to promote an idea ahead of time before the next FOMC and before the next potential cut. As we've talked about before, you can always go to FedWatch, CME FedWatch. This is a free website, doesn't cost you anything. You don't need an account to go here. It will have the FOMC scheduled dates, and it will have the projections of where we were a month ago, where we were a week ago, and where we were yesterday compared to where we are now. So this gives you a way to keep track of things for yourself. When I was new to trading, I would hear people say things like, oh, that was already priced in. And I would get frustrated because I'd wonder, how the heck did you know it was priced in? Where did you see that? You're looking at the same chart I'm looking at, something like SPY, QQQ. What was priced in? Where? How did you see it? This is how you can see it. So, are they unwinding potential cuts? Are they, pricing in potential cuts? This is how you can see it, and this is where you can see it. It doesn't cost you anything. Our current level is 425, and you can see at 44%, our chances for the May 7 meeting of not getting a cut have gone down. So our chances of getting a cut has gone up from 44% to 55%. They're pricing in a cut in May. Just a small one, 25 basis points. And it looks like they're pricing in another one, another 25 basis points for June. So they're unwinding the one cut and adding 2 cuts by the June meeting. I think they're getting a little ahead of their skis there, but whatever. And then tonight we're going to get some data out of Japan. If they have a message to send, that would be a really good time to do it. So if you're a nighttime trader, if you're going in and trading the futures in the evening, pay particular attention to the clock tonight and listen to something like Bloomberg Asia. It'll help you, get the tenor or the mood, kind of set the tone for the evening's trading. This was let's see if we could find that chart. Yeah, this was the additional reciprocation announcement that came out earlier this morning. It's one of the things I like about Finance Juice. It doesn't cost you anything to have an account here. And if you're using this website, I highly encourage you to make an account, even if you're just using a free account. That way you can use the filter and you can filter out the news that you don't want. This is a news aggregate service. It gets news from all over the place. And I don't know about you, but I don't really care what CNN and Fox and MSNBC has to say, right? That kind of trash just clutters up my news feed. So I turn that junk off. If you don't have an account, then it won't remember your settings and you would have to go in every single day and change the settings back to how they were. And that would just be annoying. It's just not even worth it. Not when you can make a free account and it doesn't cost you anything to do that. So we do have this threat with bonds. Keep your eye on treasuries. They are right now, in my opinion, one of the biggest things to keep our eye on. So do that. 47.35 is the put wall. We would have to break new lows to get there. It's where we would expect them to monetize puts. Spot Gamma had mentioned that in that fake news that we got on Monday that popped us up into like 5,300 or 5,290 area, that they bought a bunch of puts there, and this is their target. So we get down there, they would monetize those puts, right? They bought to open, they would sell to close. Now, just because you're hearing me say they're selling puts there, that's not selling to open, right? It'd be completely different. They're selling to close. But we would expect that to provide a temporary measure of support, even if it's just enough just to bounce us a fraction before we continue to fall. If you want to know more about the call wall or the put wall, you can always go to the Spot Gamma website and look at their glossary or their FAQ, frequently asked questions section. You don't need an account to see the FAQ section, and you can read all about the call wall, the put wall, the volatility trigger, and the zero gamma levels free. We're still looking at elevated volume in the futures, 317,000 in the overnight. It's way higher than our average, which is around 70,000. But it's lower than what we've seen recently. Friday was 500,000. Monday was close to 500,000. So only 317,000 seems a bit light. Yesterday was 200,000. So it's a little heavier than yesterday. It's still a lot. We're under the 3 and the 10 and the 20 and basically every other moving average out there. We're under all of them on the daily. For the weekly, we're also under all major moving averages at this point. If we're going to be looking for a sustained push to the upside, even trying to get back to, say, half of that last drop, then we would still need to cut above the 3-period and the 10-period moving average. If we get to one edge of the ADR early enough in the day, we can go to the other one by the end of the day. It tried that. It didn't make it. stalled out before it could get there. That's a bit of a liquidity gap. And so, we came back down and filled that gap. Now we're just focused on the low. It's worth noting that we are outside of yesterday's range. So we're inside day breakout at this point. When we have an inside day breakout and we come back in, that's generally a positive thing. So we don't want to lose it once we have it. Once we get back inside of yesterday's range from a downside drop, you don't want to go back outside the range again. And so the fact that we are is a bit of a signal. Definitely not a good one. From here, it can get a lot worse fast. So if we break our own Globex low, then we want to target the low that was set in this current event, this backdrop, which is what, like 48.32 cog line. That would be the downside target. And then anything that Spot Gamma has to add to the conversation from their founder's note in the AM, which I'm checking now, it looks like they just came out with. So I'll get that shared out. They've got support at 4,800, which is, you got the 48.32 cog line, 48.11 cog line, and then 4,800. And at just a quick glance of the AM notes, looks like they're talking about the B of A credit spreads and liquidity risks. All right, I've shared that in the chat. You should find Spot Gamma's briefing. Just, be mindful that I haven't read it yet. You'll have a chance to read it before me. All right. Looking at the distance from the weekly floor pivot, since we set the low earlier this week at 48.32, we're not below that. So, that's kind of our metric. If we look back in the past at how far we've traveled away from that weekly pivot, the average was somewhere around 6.5. Now, we went deeper than that. That's how we ended up with an average. And we can go deeper than that. Now, there's still the idea, though, if we get too far away from this weekly edge, yeah, that's an 8.5, close to a 9% move away from the weekly pivot. That's extreme. I don't think we had anything like that since COVID. And in these conditions, in this type of market environment with the really low liquidity and deliberate smackdown attempts, typical measured move has to be set aside, or even typical reversing points, distance traveled from moving averages, distance traveled from floor pivots. They're only going to give insight. They're not going to give us true levels of reversal. Today's floor pivot is really close to yesterday's pivot. And the channel for today is much wider than yesterday's. price opened up underneath it, and that's bearish. We haven't hit it yet, so we're still looking at an MDP. That's a missed daily pivot. Markets generally hit their pivot 80% of the time, so when we don't hit it, kind of stands out a little bit. If we continue to not hit it today, it will be an MDP officially tomorrow. We don't count it today. If we continue to stay bearish and push to the downside, we've already attempted to mess with S1. We've got S2 at 47.21 and then 43.56. I would just round that and say 43.50. We're at 49, so 43 sounds pretty bad, but it's not that bad. Buckle up, right? Looking at the volume profile, we've got a pretty wide distribution. There are some high spots. So it's not a clean distribution in a D-shaped sense, and it's not a 2D. We wouldn't call that a capital B. We'd call it a double D or a 2D. It's not that either. It's just a bit messy to be either one of those. For a drive to the upside, 51.27 is the point of control, a level that we're going to struggle to get through. And there's another high volume node area at 5,002, basically. So we'd likely get hung up there on the way back as well. Ten-day, 30-minute volume profile. We're still working on what's across the top. 56.30 or 56.32 is where the point of control is now. And we're not going to get into those candles until next week sometime. We can see Wednesday, Thursday, Friday, and then finally, when we start to get into Monday, we'll start to get into these candles right here. So until then, we're just going to continue to wipe these candles out, and that's not going to do any good for this point of control that we're looking at. The only other thing that can move that point of control, if we're not going to wipe those candles out, is to sit in one spot and build up enough volume to bring this down early, rather than just having it move by default, simply by taking those candles out. At this point, there's nothing standing out down here that would give us any insight into what that new location would be. So 56.30, it's a significant level of resistance that's over our head. And if we do begin a drive to the upside for whatever reason, random tweet, fake news, some sort of concession on the tariff reciprocation, that would be an upside target that I absolutely would focus on. Right? We saw how extreme it was in a very short term on Monday when it was fake news that didn't last for even 15 minutes before they were trying to get the message out that, hey, that's fake. Don't listen to that. That's not real. So if we actually get some real news, right, and it's some positive news, 56.30. That would be a nice drive from 49 to 56. I want some of that. 5086 VPOC is broken. We got into it yesterday. We're just going to keep that line though, since we built a new VPOC yesterday. 5179, it looks like. close enough. So if we attempt to make that drive to the upside, we've got to get through 5180. I'm just going to round it up. 5180 VPOC, and then Tuesday's high, which does get us through that Monday spike, right? Yesterday, when we were moving to the upside, getting through the top of that spike was on the agenda, and we managed to get it done. It's worth looking at the amount of volume that was up there, right? It had all of this trading, which gave us volume at our POC level. But we got that much volume in just those few little candles. Spot Gamma had talked about how on Monday, when we spiked up into that level, it looked like there was traders of size just waiting there and pounded it back down off of that high. Really looks like we got a repeat performance right there. We got through Monday's high, and then there was just very large traders sitting there ready to smash this thing right back down again. At least it's consistent. Looking for a silver lining. We are still inside the weekly range. 48.77 is the week's range bottom. We have been consistently closing outside of the weekly range at the end of the week. So, even though we're supposed to close inside this range, the fact that we haven't been kind of tells us that we shouldn't expect it, right? That this would be the range that we're focused on. Even that really beautiful gapped down Monday that we had, which often in the past has signaled the start of either a really good, dead cat bounce or a really good start to a recovery back up. Yeah, that's gone. That's completely off the table. We're around 7% below the 10-day. And if we look at, say, COVID, I guess would be the extremes that got us into that spot. March 2020, COVID lows, we were more than 12% below the 10-day. So it's nasty, and it's feeling pretty extreme, but we've had worse. Remember, to get back to the 10, we don't necessarily have to go up. All we have to do is stop falling, and the 10 will come to us. It's a mechanic function, right? That's just what will happen. There's two ways that we can correct this scenario. So it's a correction. We would be looking to correct through time, where we just sit sideways and heal and digest the moves that we've had, and the 10 will continue to move closer to us. Or we flip back around and begin to mean revert back towards the 10 while it continues to move towards us. So that would be a correction much faster, right? Correction in price. More than 11% away from the 10-week. That is considered the mean, the 10-week. We're a long ways from it. But if we look back, we've been farther away than that, more than 20%. So sure, it feels bad, but we've seen worse. It's not normal though. If you think about it, we closed the whole world down during COVID in a significant crisis. And so it got really bad really fast. This is just continuing to get worse and worse and worse, traveling in that direction lower. So we should see a pause. Doesn't mean we're going to get it, but if we look back at when it did get really bad, it went in stages from 5 to 10, and then from 10 or 15 down to 22. So it wasn't like we just went from 0 to 20. And it is worth noting that we were at minus 11 and then we were at 0 that fast. Right? So when a reversal comes, and eventually we will have a reversal, when it comes, it can be really violent to the upside too. That's part of the risk that everybody's trying to struggle with right now. I had a lot of people yesterday asking about different scenarios to try to play SPY, SPX, QQQ to the upside, and I mean, or to the downside. And I get it. You know, we're all bearish right now. It makes sense that you want to go short, but it's difficult to try to play a short move in this condition. One, shorting from the hole, just technically speaking, is not something that most analysts would tell you is a good idea. Shorting from the hole is usually never a good idea. Two, the options prices, puts are crazy, crazy expensive right now. So for your puts to even make any profit after you pay an exorbitant amount of money for them, you need another extreme drop. And sure, we continue to get the extreme drops, but if we don't, if we just grind lower, those puts aren't going to monetize. It will have to be extreme drops, and they are crazy expensive. So it's a huge gamble to try to take a short using SPY or the Qs. So the idea would be use something else, something that doesn't have such elevated jacked up premiums. There are inverse ETFs that you can use with or without options involved. That way you can play to the downside without having to get into those just really wide, horribly priced options. And yet you don't want to take the other side, right? And try to go long, because we could just continue to drop to the downside while this tariff tit for tat regime continues to go on. And even the upside options are horribly mispriced at this point. Yeah, it's a good question. Someone asked, how do you know that they're mispriced in any sort of way? Right? This is a generic way to do it, but consider it like this. If I was to build a spread and I build it at the money, now where we are matters, right? And the market's not open, and these options are going to be a little weird because we're not open and we've moved in the overnight hours. 496.48 was the official SPY close, and we're at 487 in the pre-market here, right? So obviously these aren't going to fit. But when the market is open and you build yourself a spread with one option in the money and one option out of the money, consider this at the money, right? You should see a cost half the width of that spread. This is $5 wide. This should cost me somewhere around $2.50. Now, in real world, right, you may have to give 3 or 5 pennies, and you could collect an extra 3 to 5 pennies. So it could be 255, 245, 247, 252, right? Somewhere around there. You can give or take 2 to 3, 5 pennies at most, not $3.24. That is 75 cents more expensive than it should be. Now, of course, as I said, it's not open market. So if I go way out of the money and I build a spread way out here, and I find this far out of the money a spread that costs $2.50 on a $5 spread, that tells me that we're way overpriced, that we have there's my $2.50 right there. At 515, 520. So these options are not priced in anything remotely resembling a fair value, and I would not buy them. So I wouldn't do it in a spread, and I certainly wouldn't just buy the call or buy the put. And yeah, the puts are just as horribly mispriced as the calls are. So that's a really off the cuff, quick, fast way to evaluate the cost of the options and ask, hey, are these running at a fair value? Just build yourself a spread really fast and look at what it costs. Do it at the money so that it should equal half the width of the spread. And it doesn't matter if you build it as a debit or a credit. The VIX is up close to 8% this morning. China, well, at least the XXX China ETF is up 6%. Over the last 5 days, it was down 50%. And now it's up 6. Maybe a bit of a dead cat bounce there, a bit of a mean reversion. It was down 50%. That's a significant drop. So sure, it's up a little bit this morning, but I wouldn't read too much into that. Gold and gold miners are up this morning. Gold was down more than 10% in 5 days, getting a little bit of a bounce. Doesn't make me feel like it's very bullish. And KWEB, which is China again, was down more than 20, and it's up this morning. So most of this just looks like a China bounce and a gold bounce, not because they're bullish, just because they'd already fallen a long ways and they got a bit of a beat down. Everything else is flat or down. Bond volatility is flat. Russell volatility, some bond stuff like SHI, uranium. For the most part, everything else is down. The Mag 7, Bitcoin, everything else is down. Oh, and we got pot stocks up this morning. Yay. Definitely don't want a rally on pot stocks. So keep your eye on the news this morning. With everything down like this, if we do start to move to the upside, it's very likely going to be the kind of move that we saw Monday, right? With some news connected to it. I don't see how we could get that sort of drive without the news. And if we're looking for some sort of bounce in a mean reversion sort of way, we would want things to bounce collectively. Yesterday, we did see some moves with the ES or SPX, if you were looking at that, and the VIX. And I was timing this breakout into the later part of the day. It was this breakdown here with the ES. Maybe that's a bit early. I think it was this one up here. $130, $130. Yep, that was the one. So we had the VIX up, we had the ES down, and we were doing this little bit of a run here. and then we faded back down. When we finally had the VIX breakout and the ES breakdown in sync, then we started to really run. Before that, though, when we were just chopping around in here and chopping around in here, we were getting these false starts like it really wanted to run, but the VIX was still underneath that midpoint right there. So we weren't getting anywhere. Then they started to work in sync again. So, use it while you got it. Get the advantage when they line up, if you can get them to line up. If we go to break this low, for an example, then we want to see the VIX breaking that high at the same time. So perfect case in point, we just tried to test that high on the VIX. We did not try to test that low in the ES, right? That's exactly what I'm talking about. So if we're going to break this low in the ES, we want to see the VIX breaking that high at the same time. If one happens early, it can lead us, right? Or it's a false start that one of them is off, one of them is lying. And at some point, it doesn't have to be the VIX. It could be something else. But while it is the VIX, use the VIX. Just remember the VIX doesn't move this market, right? Just a gauge. It's just a tool, something that we're looking at. The VIX doesn't move anything any more than those floor pivots that we were looking at with the channel and the discussion about it's a wide channel, breakouts likely won't work, or it's a narrow channel, breakouts might stick and we could really run. Those floor pivots don't make us break out and they don't stop us from breaking out. Well, the VIX doesn't move us either. We're not going to break out or not break out because the VIX did something. But there are VC funds, volatility control funds, and they have to respond to what the VIX does because it's literally in their name. They're funds that are based off movements in the VIX. So they do have criteria that says if the VIX goes above this, we have to sell X amount. If it goes below this, we have to buy X amount. They're non-discretionary trading firms. They don't get to play their gut or their instincts or do a deeper evaluation. They just have to trade based on the VIX. And that buying or that selling can move markets, which is why a lot of times when the VIX moves, we look for it to correlate or sync up with something else. So watch the clock, keep your eye on the news. We've got a lot of Fed speakers today, and the 10-year auction and minutes and executive orders are on the table today too. Again, more orders. So what I got for you guys, be careful, be safe. I'll see y'all tomorrow.